I have to tell you, we're driving to Portland today. Did you know it's April Fool's Day?
I do now. I forgot it was April 1st today.
My family never forgets.
I should know because I paid my mortgage payment today.
I got in my car today, and Michaela and Jess had like mischievous smiles, like they're up to something. I'm like, what are they up? I'm looking around the garage. I'm like, what do they do? And I get into the car, and they sprayed my daughter's perfume in the car. So when we drive to go get lunch today, it's going to smell like we're inside an Ulta store. It's very, very strong.
Why is that so bad?
Hey,
is it good perfume?
Windows. No, well, I mean, I want to be careful.
Okay,
I say good. I don't love that she's wearing perfume.
I see.
And also is kind of, I guess, preteen girl perfume. So it depends on whether you think fondly of, like, I still think fondly of like herbal essence. Do you know what herbal essence
is? I do.
Was?
Yeah. I remember my first girlfriend, we used to have to go to like those stores to pick out perfume. And it like is ingrained in your mind. Like that specific
what that smell
scent.
Yeah. I mean, herbal essence.
I'm excited to get taken back when I get in your car later today.
Tell me if this is what your like 6th grade girlfriend's
exactly
perfume.
That sounds like. Good.
Anyways, I was in the car with her the other day. And we were talking, of course, about AI.
Mm-hmm.
And
because what else do we talk about?
What else are we going to talk about? And, we were talking about whether AI would, replace us or like destroy us, Terminator 2 style.
You're talking to Michaela?
Talking to my daughter about this. This is not what you'd expect for
a 6th grader.
Father-daughter conversation.
Yeah, exactly.
Well, here's why I'm talking to her about it, because she provides perspective. And I thought her perspective was pretty interesting. She said, I feel like what's going to happen is the robots will replace us and they'll do all the work for us.
Okay.
And then they'll be like, why are we doing all this work? We should just have the humans do all the work. And we'll just
relax.
It's
the Matrix.
It's not the Matrix because it's like a step. It's like slavery, basically. It's because Matrix were all batteries.
That's true.
Right?
Yeah. So I guess the only difference would be is as opposed to enslaving us to become batteries, you enslave us to be people.
Yeah. And but we still get to be people. Yeah. We're probably actually worse off than the Matrix because in the Matrix, you think everything's
I would much rather
fine.
be in the Matrix.
Yeah.
But I don't know. I guess, do machines and robots get tired of doing work?
I don't know if they'd get tired of doing the work. I think
because I mean, the reason like we have to sleep. So that's the reason why we get tired of things and lazy. Like, I don't know if robots would get lazy unless we like programmed them to be.
They just don't want to do the work. Like there's certain jobs that you want to, like, I don't want to go back and be a waiter anymore. Like I've done that. And I was imagining that yesterday and I was like, could I do that again? Like, I don't know if I would do that again. Right. Like it's not because I need sleep every night. It's because I just don't want to
do it.
I love waiters. I always tip my servers.
Same.
Excessively. But I don't want to do that job again. I appreciate how crappy that job is sometimes.
Yes.
So I tip for it. Anyways, I thought it was a good perspective.
That is a good perspective. I hope we don't get enslaved by machines. That wouldn't be ideal.
Is it better than getting destroyed by the machines?
No, I'd rather. Well, like becoming a battery and living in the Matrix.
Right. Battery aside.
Are we still in the Matrix? Okay.
We're not the Matrix.
Okay.
We're just either dead or slaves.
It depends on the extent of the slavery.
Yeah, like what if your slave day? And what if this is basically just a 9-to-5 job?
Well, in the Roman Empire, slaves got paid. In the Roman Empire, slaves got paid.
And let's not celebrate slavery.
No, I'm not. But I'm just saying, like slavery in the Roman Empire, they got paid, they got treated well, and stuff like that. So it depends on the extent. It's like, if you're like, I'm going to go down another rabbit hole, but you brought it up. All right. So
I didn't bring up slaves.
You brought up slaves. You brought up slaves. So I've been listening to this thing at night and it's called Bedtime History.
Does it help put you to sleep?
It actually does. Yeah. I pass out in, like within 20 minutes, but it was a history lesson on what it was like to be a pirate in the 1700s.
Okay.
And it was talking about how a lot of merchant sailors were basically slaves. You went on a merchant ship and became a sailor. So you could basically afford the lowest amount of ends meet possible. And you would get scurvy because there's flat water. That's all like moldy and gross. You were given one little piece of bread for the entire day. That was usually disgusting and had malnutrition. Yep. And then you were whipped all day. And then at the end of your voyage, once you got to the port, the captain could withhold payment if he wanted to. You weren't guaranteed payment.
Wow.
He could say you didn't hustle up enough, you didn't sharpen whatever, like as good as you should have. And because of that, I'm cutting your pay in half. So a lot of the times people would just get paid enough to afford like one decent meal. So when they were boarded by pirates, a lot of merchant sailors like welcomed the idea of becoming pirates because it was a true democracy on the pirate ships and it wasn't a slave-based thing. Most of the time people were there by free will. And I guess when it comes to your slavery question, it depends on the extent of the slavery. But then that would bring back piracy in my mind. It would be Star Wars.
Okay, now it's Star Wars.
Yeah.
First it was Pirates of the Caribbean, and now it's
Yeah.
Star Wars. I think I'd be remiss if I didn't point out that there weren't a lot of man on the street interviews of the slaves in the Roman Empire. Like,
No, there's a lot of counts.
I'm just saying there's also a lot of, histories written by the victors.
Yeah, I mean, look, I don't think being a slave in the Roman Empire is an aspirational job
or like way of living.
But they treated them well.
Yeah.
Better than other cultures.
Okay.
Yes.
I'm going to transition.
Please.
Because we're talking about history today.
Yes.
We're talking first about most recent history with our market recap, right?
Mhm.
But we're also going to be talking about this moment in history that we're in.
Yeah.
And how it is similar to previous moments or dissimilar from previous moments and what to expect. Welcome to the Compound Growth Podcast with Colin and Wheeler, where we talk all things growth. From financial growth to career growth, personal development to societal progress, we explore how each layer builds on the next, compounding over time to shape who we become. Each week, we break down complex ideas and emerging trends into clear, actionable insights. Because growth isn't just about numbers. It's about understanding the world and our place in it. So I got charts for you. I got handouts today.
I'm excited.
And I'm going to ask you to go through these in order.
Okay.
But don't skip ahead. All right. Our first chart is a snapshot of the markets in March 2026. So we're looking at the U.S. stock markets, S&P, Nasdaq. We're also looking at international, Europe, developed, emerging markets, et cetera. March sucked. Like we saw it every day. Do you know there wasn't, and there hasn't been, a single 2% down day this year? It's been just kind of like...
We had a 2% up day.
We did. We haven't had 2% down days. It's just been kind of like death by 1,000 cuts.
Yeah, it's been a slow bleed.
But what's good about that is it's not like the market overreacting necessarily.
Yeah, I mean, I don't know. I'm sure you obviously remember this when we were in COVID and we would just hit the breakers.
Yeah,
like
right.
Every 4 days.
Like, breaker, done.
Just done. Market closed. Market closed.
Everybody take a breath.
Yeah.
But it was like a very orderly decline, right? Through March, you can see that the S&P and the Nasdaq were both down around 5%.
Yep.
Emerging markets had a 13% decline just in that 1 month. Developed Europe, et cetera, was down 10% in just that 1 month. So it was a pretty crappy month for our diversified portfolios.
Yeah, it was. But, and I don't want to fast forward through your charts.
Yeah.
Diversification did really help.
It did, if you had the right kind of diversification.
Correct. Yes, it
right?
did.
All right, so second chart here, as we flip to year to date through the first quarter of 2026, same indices, so S&P, Nasdaq, Europe, et cetera. And you can see that actually emerging markets have been a good diversifier this year. They're only down a fraction of a percent.
You want to know what I find kind of funny is, I don't know if you get this, but a lot of clients will hop on the phone and say the market's crashing.
Yeah, of course.
What's going on with my portfolio? Things are terrible, whatnot.
Yeah.
And I mean, they're not wrong. March was a rough month.
Yep.
But if you look at it year to date, it's really not that bad.
Yep. I mean, if you have the average of these 4 indices, you're down what, 3.5, something like that.
Yeah.
Nobody likes being down, but it's not exactly like, Colin, the national.
It's not the 30% decline in COVID or something like
National
that.
Guard for random things now. Anyways, so yeah, down 7%. Maybe is the worst. Is the Nasdaq is the worst of all these. Going to the next chart. This is why it feels a little bit worse, right? This is off the highs, right? So looking at March, adding it all in, we went up to start 2026, right? So it's really that we made some progress and then we retreated from that progress.
Yeah, I think we hit 4% was basically the peak in some of the indices, and then from there it just went.
Yeah, exactly. So that's why when you talk to a client right now, And, they're like, oh my God, what's going to happen? The market's crashing, et cetera. And then I like log into their portfolio. I'm like, you're up 12% over the last year. Like, how are we? It's because of the progress that we made and that we're giving that back. I think that's a tough experience.
I think it's tough to go from a high watermark and then see that number. Let's just say you were at $2.8 million of investable assets. Then you finally hit 3 million. And once you get to 3 million, it drops back down significantly.
Like
you're going to be like, I want to get back there.
Yeah, I was there. And then
that's where I should be.
You anchor to that number.
Correct.
Yeah. All right. So I want to draw your line, or your eye to that top line, purple line. It's negative 6% on the S&P 500.
Yes.
Okay. That's through the first quarter of 2026.
Okay.
Final page. There's that negative 6%.
Yep.
And there are the top 7 stocks in the S&P 500.
I pulled this up for a client yesterday.
I thought concentration was going to destroy the stock market.
Not at all.
Here we have the worst of it. Microsoft down 23%. It was down 30%.
Yeah, it's actually come back.
Yeah, but down 23%. Meta down 23%. Right? We got Google down 16%. Amazon down 16%. The best one of these is Apple down 9%. And that's underperforming the stock market. These are the 7 largest companies in the S&P 500. They're not the Mag 7.
No, they're not.
But they're all getting smoked.
Yeah.
And yet the market's holding up.
Diversification. Well, we should talk about ExxonMobil too, and everything like that, and utilities in general. Like if you look at the, I think it's MSCI utilities yesterday, I think it was up 6.5% year to date.
Yeah.
Utilities has been amazing year to date. If you have some fixed income, that's also done fairly decently if it's short term. Yeah. You have energy has absolutely ripped with the closing of the Strait of Hormuz, which we'll talk about later. Yeah. But there are a lot of sectors that have performed really, really well. And our value-based funds that we have, our index funds, they have also just in general been awesome.
And I think it's what's tough is that there's a narrative out there and you have to question them because people will point to something and say, see, this is bad for the stock market.
It is.
And then those stocks get crushed and the stock market does fine because if it's a healthy stock market, there's underlying rotation. You have Exxon that you brought up.
Yeah.
That's a top 10 stock in the S&P 500 now.
Yeah.
And it wasn't just a year ago.
Yeah. If you rewind the clock back a year ago, it was a completely different chart.
Yeah.
And no one really everybody wanted to hold the Mag 7 and those companies that we just named that were down 20%. Those were the ones that everybody wanted in their portfolio. Now it's flipped. Everybody wants the ExxonMobils. Everybody wants, the BPs and all those because they're ripping this year.
Yeah. Well, I guess if there are some overreactions in the market, it could be in those cases. It could be the SaaS apocalypse where just like the ServiceNows and the Workdays and the Salesforce and Microsofts are all getting slaughtered because of AI.
Yeah.
Right. But there's also the overreaction to the other side, perhaps. Like maybe we're starting to I personally think we might be overpaying for something like Costco or Walmart because they're brick and mortar and they aren't going to get destroyed by AI. So now we're overpaying for companies that don't necessarily have the growth profiles that we're paying for.
Yeah. Did you see Oracle yesterday too?
No.
Announced several thousand jobs are going to get laid off.
Yeah.
Yeah. Right? That's super common these days. You see there's a lot of jobs right now that are probably under the gun.
Yeah. But you know what's interesting? Because who was it? The guy that I'm spacing on his name right now. Jack, Dorsey. That's it.
Oh, yeah.
And he took over the company formerly known as Square. And the first thing he did was lay off everybody. Mm-hmm. And I saw a great...
Well, that was famous Elon Musk with Twitter too.
Right, yeah. But I saw a great GIF going around. And it's Jack Dorsey at the company quarterly meeting. And it's just him and a bunch of computers, empty computers at the conference table. It's just him and his AI bots.
Yeah.
Anyways, those are his shareholders too. But you're certainly as a company being rewarded for shrinking headcount right now. It looks like an efficiency. But I heard the CEO of Paylocity speak last month, and they don't necessarily work with Meta, but they work with a lot of small, mid-sized US companies. And what he's seeing is stability. There's just there's no shrinkage in headcount. It just looks very, very stable so far. And maybe that's not always going to be the case. But maybe right now, the layoffs are really clustered in the largest companies because they're the ones that got the most bloated and they have the most room to cut.
100%. I mean, if you go back the last few years, the amount of hiring that those companies did was outrageous because they were trying to scale their AI and their infrastructure so
Yeah.
much with the build out of these things that, yeah, at this point, you probably overhired.
Yeah.
And that's not to say that you're taking your company and you're shrinking it down and trying to do, have one person do 20 different jobs, but you probably were overstaffed from the very start.
Yeah.
And now you're having to correct for that, especially in, probably a bit of a lull in the market here for the foreseeable future. We'll
Yeah.
see what happens.
Yeah. Hopefully, I mean, look, that's the thing is nobody knows how
No
long
one
this is
knows.
going to go for.
Yeah.
Why don't we get into the Strait of Hormuz? Because that's your topic for the day. And I wanted to dive into that with you.
Yeah. And I know you're going to talk about some history of war as well. But I guess something that I wanted to talk about today is war in general, because war can be seen as a business and it is a huge business. I was just thinking about this because obviously a lot of money is made in war. And a lot of companies are focused on war. And I had a conversation with multiple clients actually that wanted to buy defense stocks. And I don't know if you've had this conversation lately, but people are confused about why defense companies are down year to date. I had a client who owns a defense index fund, and it's focused on, the Raytheons of the world, the Northrop Grummans, BAEs, like all of those different types of companies. And he doesn't understand why it's down so far year to date. And I think what a lot of people fail to realize is a lot of the revenue, and pretty much all of the revenue of these companies, is made through government contracts. It's not like they have a bunch of missiles on a shelf and the government walks in and
Everybody goes on a
"Take
shopping
10,"
spree.
exactly, and loading up their grocery cart. So when war breaks out, that's not something that's necessarily going to drive revenue,
Right.
but that's something that's going to already have been priced in through government contracts.
Yeah, to date, right?
To date.
It doesn't have an immediate impact.
Yeah, upset. So I wanted to just grab some stats and just think through how big of an industry war is in general. One big stat that I thought was very interesting is we have spent $8 trillion on war efforts since 9/11, which makes it basically one of the largest industries.
What comps
in
to
the
that?
US.
Like, do you know?
So exports in regards to weapons, creation of weapons, government contracts, you have aerospace, defense, like all of those things combined, not to mention building new facilities, building new bases, like personnel, all of that stuff has been $8 trillion dedicated towards the funding of war efforts.
Now, is that $8 trillion in government contracts, or is that
It's everything.
So it's $8 trillion in just earnings by these businesses.
Correct.
Okay.
Yeah. And future obligations that for contracts that have already been signed and agreed upon will push that over 10 trillion.
Okay. Wow.
Yeah. So it's extremely significant, but it's basically not a line item. It's an economic force.
Sure.
If you will, because that's not a one-off thing. War has been, I'll say, economic driver since the Roman times. Going back in history, I'm going back to the Romans. But if you go all the way back through history, and I think people look at war and think the market's going to crash. Almost every single war we've had going back to 1942, at the conclusion of that war, the market has been a year higher.
Yeah.
It has been a higher a year later.
What's the exception?
Well, the exception is what's going on during war. So I think this is the issue is people think just because there's a war, that's going to cause the market to go down. But it's not necessarily the war that makes the market go down. It's the effects of the war. So perfect example, Strait of Hormuz. It's a 21-mile wide strait at its narrowest point that when you close that down, 20% of all energy supply is essentially halted, which is going to cause oil prices to go up, which if you think about the consumer, is going to affect travel prices, is going to affect your gas, is going to affect so many things in regards to normal basic materials that you purchase, because a lot of those materials are imported. And if travel and importation costs increase, then the end consumer product, the price of that is also increased.
Yeah.
So it drives inflation. And that is probably where a lot of this is maybe lost on people. Is it's not so much that the war is going to cause the market to go down. It's that war can drive inflation higher and make things more expensive, in addition to energy consumption and things like that. So there's certain areas that are negatively impacted, but there are companies that do benefit, like defense contractors and stuff like that.
Mhm.
So that's kind of the basis of what I was researching that was a good refresher for me when I was going through my economics courses.
Yeah, that makes sense. And I'd be curious to see, because a lot of the like SRI type investors have been doing fairly well for a long time, because a lot of companies have worked their way to qualify as an SRI, socially responsible investment, to the point where you can have something like Meta go,
Right.
there's a socially responsible investment when their number one product is like banned for teenagers in 14 countries because it's so dangerous.
Totally.
And obviously, outside of guns and tobacco,
Yep.
energy's always been the big culprit that people don't want to have in their portfolio.
Yeah.
And I haven't looked, but I would be interested to see what like the SRI version of the S&P 500 index fund is doing this year. Because if you don't have like energy in that portfolio, or maybe some of these energies companies have gotten to the point where they're like buying carbon coupons or whatever,
Right.
so that they, now they're SRI. But if you don't have exposure to energy in a year like this, you're definitely going to underperform, and you're going to feel that pain a little bit more.
Yeah. Oh, totally. I mean, if you go back to the 1970s and think through like stagflation and what happened during those times where interest rates, were like 17 and a quarter for a mortgage, a lot of that was caused by energy prices. And that caused a lot of the issues, was that spike.
Yeah.
So I think a lot of people are fearful of that happening again right now. I mean, I filled up my car yesterday and it was $4.05 a gallon.
Yeah. Well, the boomers still feel that. Like
They
still,
do. That's ingrained in them.
Yeah, they remember stagflation.
Yeah,
and they have a lot of wealth.
I was just talking with my dad about this and how he remembers going to refinance his house every 8 months because he started at 17 and a quarter.
Yeah.
8 months later, it was 15, then it was 14, then it
Yeah.
dropped to 12, and then it kept going down and down and down.
Yep.
So the fear is that if you didn't grab it, it's going to shoot back up.
Yeah, right. Because that was the recency bias. Right?
Yeah,
really,
totally.
Really a play there. And then you have obviously people who remember sitting in those lines where, like, based on your license plate number, like it was an odds or evens day, and you got to get gas that day.
Yeah, totally.
So like it's when those are like engraved in your memory. We have one client, and no matter how hard I try in his financial plan, I cannot make him run out of money, and he cannot accept that. Right. He's like always fearful. And it's because of his life experiences. It's what his parents taught him. It's what he lived. It's like there's something that's going to happen, and I need to make sure I'm prepared for it.
Yeah, there's literally nothing that you could do. He could have $1 billion and spend $20K a year.
Right.
Still wouldn't matter. That's fair enough.
Yeah.
But yeah, so just going through that, I think the refresher for me as I was doing this exercise was a reminder that markets are very resilient to war, but who is impacted is the actual consumer. Through things like inflation, through things like energy prices and whatever it might be, interest rates going higher, all of those things affect the consumer. But markets in general are actually very resilient to war. And most of the time it is priced in. And that's probably why we haven't seen so much of a decline in the market. And that's why diversified portfolios, if we look at things like value and energy stocks, are actually only down 3 to 4%.
Yeah.
So that was the big refresher for me, and thinking through the Strait of Hormuz and the economic impact that it has.
Yeah. I mean, that makes a lot of sense. There's a great scene in Landman, the first season, where he's talking about solar power and oil, and all the oil that goes in to solar power. Actually, he was talking about windmills, I think, or windmills.
Yeah, turbines.
And like how much oil was used to build the turbine, or how much oil is used to pour cement, and how much oil is used to make water bottles, and how much oil is blah, blah, blah. It impacts all these different areas that you don't think about.
Yeah.
And so it has to your point, a big impact on the consumer, and the market is forward looking. So the market is thinking out into the future and saying, what will the impact on the consumer be? I'm going to discount the value of the stock market based on that. And then by the time we get there, so let's say the market's thinking about this fall, by the time we get there, the market's already priced it in.
Yep.
And then we get so the market always recovers before the economy recovers. So if you're ever worried about the economy recovering, the market,
Look at the market.
Right.
Yeah.
I heard a fun fact. And, sometimes you hear these facts and you're like, where does this come? What are they looking at? But Tom Lee was on CNBC the other day. Tom Lee, the fund strat research guy. And he was talking about how the market bottoms in the first 10% of every war. And I'm like, what? So if you think about,
what does that even mean?
It means that if, let's say that this is a 2-year war,
okay,
then the market would bottom in the first 3 months.
So if we think about the war in Ukraine, the market bottomed. It took like 3 or 4 months. What were we down? 24%?
The market bottomed in October of that year and it peaked in January. So it was a 10-month process.
It was roughly 10 months. So then that would mean
that would be let's call it a 6-year war.
Yeah. Okay.
Right.
I follow.
Yep. So there's often damage that is done and it can be significant damage. And the worst of it is like World War II was when you saw the market really struggle for a long period of time.
Mm-hmm.
I have a whole bunch of examples of more recent wars or 9/11 or, Operation Desert Storm or whatever.
I'm excited.
We're up against the clock, so I'm actually not going to go through all this anymore. But
you'll have to hand it to me because, as you know, I'm a history buff.
You can read it up.
So
read on it. It's really good. I thought I did good research on this, but the overall takeaway is kind of what you said. First and foremost, we have to remember that volatility is the price of entry. That's what Morgan Housel said. It's a great quote. And it basically means that if you're going to invest in the stock market and you're going to take this ride and benefit from it, you have to be able to handle the near-term volatility.
Absolutely.
Right? It is not the disease. It's a symptom. It's meant to be, it's a part of the market.
Volatility isn't unusual. It should be expected.
Right. Yeah. It's not a flaw. It's a symptom. That's what I meant to say. So when you look at just all these different scenarios, you brought up Ukraine. That's a perfect example. So when the Ukraine war started, everybody was talking about commodities and Ukraine is the bread basket of Europe, et cetera. And you saw futures, agriculture futures skyrocket, right? And everybody's trying to price in the impact on things. A bunch of money spent on defense contracts and we're sending missiles and Elon Musk is sending, Starlink and whatever. And the market goes through the process of pricing all that and then bottoms out and moves on. Mm-hmm. And I think you have to also understand the other elements that are at play there because the Ukraine war might have been, one data point that drove the market south. Interest rates rising were way more impactful and way more significant. So if you have the situation that we're at right now where the Strait of Hormuz is closed down again, I say, because it's the second time in the last 5 years because we had COVID, right? And nothing was shipping and blah, blah, blah. So we've dealt with these disruptions in shipping and logistics already in this decade, and we've gotten through it, right? So what we're dealing with is just near-term volatility. I think that what people get lost on or with is they want to point a finger and they say this is happening because of the war, or it's happening because of uncertainty with AI, or we have a new Fed chief coming in.
Yeah.
Or, and maybe this is related to the war, we have, a president he doesn't tweet, he does whatever, Truth Social.
Truth Social, yeah.
Right? Who will say one thing the next day, he says another thing, and he just sends us all over the place. We haven't had, as we said, we haven't had a 2% decline, but we've had a big up day, and the last day of March was up the Nasdaq was up 3.5%.
Yeah, it was massive.
And that was because of speculation and unconfirmed rumors based on whatever.
What he said.
I think we live in this world right now where there's volatility in the stock market. There's a lot of political volatility. And so people connect those dots. And I look at this and I say, the stock market has a good way of filtering out all the noise. You can say that if we look at Liberation Day and the lows there, Trump tweets or Truth Socials. What do you call that? I don't know. Truths?
Yeah.
That seems stupid. He says something and he says Trump tweets, buy stocks. And then the stock market goes up 6% that day.
Right.
And you can say, well, he's going to influence the stock market to some degree, but then it normalizes. And it only went up 6% because he sent it down 20.
And the stock market, to be honest, hasn't had, since the tariffs, I really can't think of a time up until maybe the last few days where the market has actually reacted off of something he said.
No, it does a lot. It's just a little, what you'll see is intraday.
It's very small.
It goes up and then it comes back down or whatever. But there's all these different headlines. And it's just that we live in a world right now where the president creates a lot of headlines. And if you just go backwards, Biden was like sleeping the whole term. So I don't know.
I mean,
what
you
the
never
hell he
heard
was
anything.
doing.
Yeah.
And Obama didn't create headlines.
No.
So like, if you look at just like, we live in a world that you can look at Obama and say, hey, he used, grassroots and, social media to get elected.
Sure.
Right. Trump uses social media to just spew whatever the hell is on his mind every night. That's a new part of the market that we have to navigate. But it doesn't control the market. It influences, but doesn't control. And we have to remember that the market is smarter than any one person. It's certainly smarter than you, me, or the president of the United States. And it's just sussing out what it sees coming. And you have to just be along for that ride because, 75% of the time, market goes up.
On that front, I was having a conversation, and this was I don't know, maybe it was last week, but regardless, the client was very concerned about the war. And they're like, my portfolio is getting blown up.
Yeah.
The war is tanking everything. And I'm like, well, the war is not tanking everything. You're super heavy in tech. And the fact that you own a huge chunk of NVIDIA, Facebook, Microsoft, all of these companies that have gotten smoked 20%. Well, actually, this was last week, so it was way more than that at the time. That's the reason why your portfolio is down. It's not necessarily the war. The war hasn't helped. No. It hasn't been a net positive for you. But the fact of the matter is that a lot of these companies have spent a ton of money hiring people and building out AI infrastructure, which is now becoming reflective on their balance sheet. So to your point, while the war is a very polarizing topic at the moment, that's not what's driving everything that's going on right now. There are other things that are happening in regards to company earnings, have AI being a huge thing. Companies were up huge last year. And is that sustainable every year? No, of course not. Yeah. It's not. It doesn't make sense. You're not going to get a 20% year every year. So I agree with you. It is a good refresher to run through the fact that while a headline is polarizing and it's what everybody's focusing on, the market doesn't care about that stuff a lot of the times. The market's also looking at 10 other things beneath it. And it's a collaboration or I'll say like a melting pot of all of these different things that will impact the portfolio as a whole.
I kind of think of it like if you're ever driving down the highway and it's a really windy day, you've ever felt like the car get just like pushed a little bit by the wind? Mm-hmm. That's what happens with the market, right? Mm-hmm. Like it hits traffic jams.
It's a good analogy.
Right? It has wind pushed in and whatever. But ultimately you get where you're going. And I realize that somebody could throw a car crash example into that, but
a bridge collapsing. That's what we like to call a black swan.
Yes. Well, also, I mean, you should really look at just like traffic as the market, not just one car, because it's all these different cars, right?
Of course.
But you also have to point out that there's never been permanent loss of capital as the result of a war. Mm-hmm. There's been as a result of fraud. Mm-hmm. It's been on single stock,
concentration.
Right? Like if you're diversified in the S&P 500, you've never lost all of your money.
Right.
And I think that what we have to remind people is that they have a right to be scared. They should be scared if they're like things. If you worry about things going down in value, you're going to be scared, and like you have a right to feel that way. But you have to just kind of compartmentalize to a degree and say, is this the money I need right now? Is the worst thing that's going to happen that I see these paper numbers go down, right? Or is it that I can't afford this big purchase that I want to make, or I can't pay my bills in retirement? Because I think what people are really averse to is permanent loss of capital. And they see these headline numbers and they say, oh my God, I'm going to lose everything. Or I don't want to go down at all. Or I want to like go to cash and then buy in at some point because I know exactly what's going to happen the next day.
Yeah.
And then just that, how many days in the market you miss determines your return, et cetera.
Yeah, all those stats.
We won't get into it.
No.
I think it's just really important to be cognizant of what the real risk is. And the real risk is not being able to keep up with inflation, not being able to pay your bills later. And anything that you need now shouldn't be taking on stock market risk.
Yeah. I mean, people always say, I don't want to lose my money.
Right.
Or I don't want this account to go to zero. Or when we build out a portfolio, they're like, I don't want to be too aggressive because if I lose this, it's going to be detrimental to me.
Right.
The thought of losing something, and to your point, permanent loss of capital, I don't want to say is impossible, but let's think through what that actually looks like.
Yeah.
To have a stock portfolio, diversified stock portfolio, or the S&P 500 go to zero, means when you wake up, who makes your bed sheets is no longer around. The person where you shop to go get your hardwood floor when you got out of bed is no longer here. your water doesn't turn on when you turn the faucet.
Mhm.
You don't order things on Amazon
It's an
anymore. You
apocalypse.
can't fly. You can't fill up your car because you won't have a car. You can't service it.
Yeah.
Companies have ceased to exist all at the exact same time,
Yeah.
which means that you and I are also not here.
I mean,
Most
we could
likely
be here,
But if all of those companies
Yeah.
are gone, you're at martial law at that point. Money is worthless.
So what does it matter what your portfolio says?
What does it matter? And the odds of that happening, I don't want to say are zero, because there's a chance anything could happen. Aliens could come down or whatever.
Yeah.
But it's so unlikely to the point where it's not even worth a conversation.
There are so many horrible things about war. The impact on your stock portfolio is temporary and not one of those horrible things. And there are lots of reasons for people to be there. Look, we're fed reasons all day to be upset about things. You can pick one of those reasons if you want. But if you're going to be concerned about the impact of war on your stock portfolio, just don't log in and look at it, because it will go back to where it was and then higher if you don't pay attention to it.
What I'll also say, to add to that, is most of the times the disasters that drive your portfolio down more are not war.
True. So, and I don't want to be cavalier. We sound cavalier.
We do.
Let's not dismiss everybody, but let's make sure everybody knows that if they are panicking, we can talk them through it. We can assess the risk that they're taking or not taking. We can point to the safety in their portfolios. We can
Definitely
walk through ways to make people feel better. If you disagree with anything that we said today, not you, Colin, but any listener,
both of us,
I feel they could email us to, we have a new email address, which is compoundgrowthpodcast@gmail.com.
Is it really?
I'm told we received an email.
All right.
So we've been asking people to say, hey, like,
if you have anything,
now they can send it to the Compound Growth Podcast.
You can also comment on the video.
All right, like and subscribe. Thanks, everybody.
Thanks. All right, bye.
Bye. The information in this material is for general information only and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.
Compound Growth with Wheeler and Colin. Sponsored by Ko-Fi Advisors. Reach out today. Yay!